you now have to model the variable consideration. You now have to demonstrate the amount that is highly probable of not reversing. So there's a lot of data analytics here. So in the new revenue standard, a lot of it is going to past transactions, to analyzing past transactions, to come up and support these percentages. So a lot more data is going to be required.
How would that situation would have been accounted for under IAS 18, the previous one? This situation accounted for under old old standard.
Well, the old standard, what we generally did is we booked the bonus when we earned it in practice. The IAS 18 was a very flexible standard, didn't have a lot of guidance. It didn't talk about the concept of variable consideration. So previously, what clients would normally do is book the bonus when they got it. But it didn't preclude you from doing it other ways. It's just that was what usually happened. Because the old standard was, I mean, IAS 18 was one of the oldest standards written. It hasn't been changed in many, many years. It was a very, very basic framework. No, it did not. See, well, correct. The difference is IAS 18 made a difference between sales to intermediaries and sales to final customers. So if it was a sale to an intermediary, you couldn't book the revenue if the goods could be returned. Correct, if it's a sale to an intermediary. But if it was a sale to a final customer, you book revenue based on estimated returns. In 18. The difference is in IFRS 15, there is no distinction between the intermediary and the final customer. So the difference there is you book the sales net of returns. That's one of the differences. So I find IFRS 15 a bit more aggressive. It is more aggressive.
In 18, if we sell it to the final consumer, then we make a provision for the estimated return.
Correct. But what we used to do is just make a provision. Yeah, and just on the profit component only. Whereas IFRS 15, we reclassify the inventory between a different category to identify that that inventory is at our clients. That's what's new. So the old standard had this concept to book revenue if it was measured reliably. The old standard, look at IAS 11, talked about did you do enough work to recognize revenue? The new standard has new concepts. The new concept of highly probable for our variable consideration, and the new standard has this concept of revenue reversal, what the old standard did not have. That's what's brand new. Time value of money was considered in the old standard for deferred payments. The new standard focuses on significant financing, which is over a year. So it's more prescriptive there. So the new standard allows you to generally recognize revenue earlier than the old standard. So the new standard is a lot more aggressive. A lot more aggressive, right? So the other thing, I just wanted to flip forward a little bit. I want to just flip forward a little bit. So when you go back to this example from earlier today, this phone example, right? So we have fixed consideration of $2,400, variable of $1,600, total transaction price of $4. Then we're going to say, all right, what is the fair value of each item? And if the fair value of the phone is half and the service is half, we book half the revenue now. Now, what IFRS has done is introduced some new concepts. When you book this revenue, what's going to be the double entry? You're going to credit revenue for $2,000. What are you going to debit? So if you remember this example, I said to you, you're going to invoice the client $100 a month, right? So then, let's say you didn't get the cash yet. So what you would do, what's new to IFRS, is there are now two types of assets. One asset is a financial asset, and one asset is a contract asset. What's the difference? A financial asset means you have a right to payment now. A contract asset means the right to payment is contingent on another PO. So this is what we've changed. So if it's we have now another category called a contract asset. So if I flip forward in the slides, I'll come back to you in a second, but if I flip forward in the slides, we have a contract asset, which is brand new in IFRS 15. So a contract asset is simply saying you have rights under the contract to receive the money, but it's conditional on something besides the passage of time. In other words, in order for the phone company to be paid, the phone service must work. That's a contract asset. If there is an unconditional right to payment, then it's a financial asset. In other words, it's a receivable. It's under IFRS 9. This is a new requirement to disclose. Likewise, contract liabilities. Sometimes a customer gives you money in advance. Now, if you don't have to give the money back, but you have to give back the service or the good, it's a contract liability. If the client can ask you for the cash back, then it's a financial liability. And this is a big difference, because if it's a financial liability versus a contract liability, that impacts the revenue recognition, which I'm going to cover in a few minutes. That's why I wanted to do this first. So we have contract liability. What does that mean? Do I have to give you cash? No. I have to give you the product. I have no obligation but to give you the money. My only Sorry, what previous one? That was for leases we were doing earlier.
No, what we were doing here, you just mentioned that we reassess it each year.
That was leases, wasn't it?
In the variable consideration.
Oh, the variable consideration.
This is the one which needs to be reassessed at each year.
Well, the variable consideration, yeah, we reassess it. So the contract value can change, correct?
So this 1900 that we recorded as a contract asset
Could change,
could change.
correct,
It needs to be reassessed at each year.
correct, correct. So we have contract assets and contract liabilities. All right? Now,
This contract asset basically refers to performance obligations that we have performed yet and we will perform later.
correct. But the client can't ask for the money back. The contract says, I don't have to give you money back. I have to give you the service or the good. No, I'm just saying the difference between a financial liability and a contract liability is with the financial liability, the client can ask for the money back. With the contract liability, for example, I have a lawyer for my tax advice, and I pay my lawyer a retainer, a deposit. And the deposit is paid to cover the work that is done. Now, I could tell my lawyer to stop working and give me a refund for whatever the balance is. So if I can ask my lawyer for a refund, then it's a financial liability. If once I give the money to the lawyer, and the lawyer has to pay me back by doing the work, then it's a contract liability. That's the difference.
How much would be the revenue recognition under both the scenarios?
Say that again?
How much revenue will be recognized?
It will be the same potentially. The only difference is a contract liability means the client can't ask for the cash back.
So with the passage of time, right? The revenue will be recognized?
No, when I do the service. So if I give my lawyer $5,000 and it's non-refundable and it's for 20 hours of work, they would recognize it when they do the 20 hours or when the contract expires, whatever is later. If it's a financial liability, they would still recognize it the same way, except I could ask for my money back, so therefore it would be classified as a different kind of liability. So contract assets and contract liabilities are very specific to IFRS.
In this case, the first year you would book 100 rupees financial assets and 1900 contract receivable.
Correct.
Okay. Next year, when you will receive 100 rupees again, you would.
Well, the moment you're entitled to issue the invoice next month, a contract asset becomes a financial asset.
So what would be credited, the revenue or the contract asset? You would get back the financial asset for 100 again, and what would you credit, revenue or contract asset?
Well, in this example here, the invoice is $200 a month, right?
Yes.
So next month when you do the invoice, you would debit financial asset, 200. You would credit revenue, 100, because half the revenue is for the phone. And you would credit contract asset, 100.
What would you debit by 200?
Because every month I said to you, oh, sorry. It'd be 100, it'd be 100, 50-50, sorry. So basically over the next 24 months, correct. It'd be reclassified, correct.
Why are we recording 1900 as contract liability in the
Contract asset. Because if I book revenue of 2,000,
This is allocated to the phone, right?
correct, correct.
Isn't the performance obligation made fulfilled?
Yes, but have they paid me?
Yeah, but the whole amount should be financial asset.
No, because what it says is you will pay me. Did we change the numbers here? It's 24 months. Okay, we're ignoring the variable consideration for now. You're going to pay me $100 a month for the next 24 months, right? So, in order for you to pay me, what do I have to do? The phone must work, right, the service? So if the network blows up and doesn't work, are you going to pay me? No. So therefore, your payment to me for what I've done already is linked to the network working. If the network doesn't work, I will get no money. So the future payments don't relate to the passage of time. They relate to the network working.
If it would have been unconditional, then you would have recorded 1900.
Say that again?
If it would have been unconditional, you would have recorded 2000
Correct.
as a financial asset.
Correct. But it's conditioned. The way it works with your phone is you only make a payment if the network is working. If the network goes down and doesn't work for a month, you're not going to pay, right?
But in that case, in the next 24 months, the revenue will be only 1,000.
Well, there's also the variable consideration, which we forgot to put there, right?
Variable consideration only 1,000 in that sense. In that case,
1600.
if you credit only 1,500
well, there's going to also be, yeah, but there are also going to be, okay, to complete the entry here, there needs to be some roaming charges, right? So let's say the roaming is 80. There would be revenue, and there'd be contract asset. So there'd be two entries that month, right? There's the fixed amount and the variable amount. And the other issue is the variable amount is wrong, then we have a change in estimate, which is another issue. And the change in estimate only applies to the undelivered POs. You don't go back and reverse the performance obligations you've already booked. So there's two scenarios there. There's the roaming and there's the fixed charge. But the point I was trying to make is up front you record a contract asset because that other money depends. It depends on what? It depends on the roaming. It depends on the network. It's something more than just simply the passage of time. Is that clear now? So, and this is what we called in the old standard, what was more applicable, it was explicit in US GAAP. We used to have this concept of the cash cap. Have you heard of this? The cash cap was saying in the old standard, we would only recognize revenue to the amount of cash we could collect. So in the old standard, if I would give you a phone and you pay $100 up front, the maximum revenue was $100. That's the old standard. The new standard is saying there is no cash cap. So your revenue you recognize could be based on variable consideration. And if your variable consideration never happens, your revenue could be recognized based on transactions that may never happen. So it's a bit more aggressive, right? A lot more aggressive. So we have to get the transaction price, and we have to allocate it to the separate performance obligations. This is where it gets, can get a bit challenging. So when you have multiple arrangements or multiple items, we have to allocate it out. How are we going to do that? So let's say, for example, you have a telephone, a tablet, and airtime. And as a package, you sell it for $1,000, but individually they have respective prices of $300, $400, and $300. So it's $1,000. And you give a 20% discount, they buy everything together. So what the standard basically says is you allocate the discount evenly to all the items. Now, if the phone and airtime sold together usually at a price of $400, then you would take the residual and allocate it to the tablet. So you allocate the transaction price to the performance obligations. Now, where it gets difficult is when the different performance obligations don't have standalone prices. So this slide is more important here. So let's say you have a scenario where you have two performance obligations, and what you need to do is to get the price of both of those, the phone and the service. Now that one's easy, right? Because you go to Vodafone, you could buy an iPhone by itself, correct? You go to Vodafone, and you could buy a service by itself. So the service and the phone, it's easy to get their prices, right? So if you can get their market price, you use the first approach. You get the relative price by themselves, and use them to get a ratio to allocate. Now, let's say you can't do that because one of the products is not sold individually. Let's say you have an example. I'll give you an example in South Africa. So when Toyota sells trucks to farmers, there's two choices. You can buy the truck, or you could buy the truck with an extended warranty. but you cannot buy the extended warranty by itself. So your choice is truck or truck plus warranty. That's how it works. So if the truck is, let's say a truck is